So let's start the complete revision session, whatever the concept that we have learned as part of level one. Um, okay, so we'll cover maybe just concept wise and what we have learned. We are not going to cover any theories. And if you need any further, maybe further explanation on the theories, we can always refer to the previous recording. We can here maybe go through the concepts like Dow theory and the trend candlestick, etc. And if you have any doubt in between, feel free to ask. So I'm just directly jumping to the Dow theory. Okay, so Dow theory basically tells the only three things about the either it helps in identifying the trend, which is uptrend, downtrend, or it is sideways. And as per the Dow theory, to identify the uptrend, this is only the simple concept if the stock price in the given time frame, so the time frame could be anything, it could be um, 15 minute, 1 hour, 4 hour, daily or weekly, depending on who you are. And when I say who you are, we'll learn about this one when we learn about the concept. So basically, we have, if you are a day trader, then you will be looking at the chart in the shorter time frame. And if you are maybe a positional trader or a long-term investor, you should be looking the chart in a daily, weekly format. So no matter whatever the time frame, just to identify the uptrend, Dow theory says that if the price is making a higher high, that means the if the next high is the higher than the previous high, and again next high is the higher than the previous high, and so on and so forth. And the second condition is if the next low is higher than the previous low, and again next low is higher than the previous low, and so on and so forth. So if these two conditions satisfy simultaneously, that will be termed as a uptrend as per the Dow theory. Okay, so this is the example. Like the higher the highs of the this stock is higher than the previous high, and the similar way, the lowest of these basically this is the Nifty chart. So lower values of the this Nifty chart is higher than the previous low, and it is applicable for all the highs and all the lows, and that is what if you see in any of the stock or maybe a commodity or any chart, it will be treated as a uptrend. Okay. Any question? Fair enough.
Nope.
And the same way, the downtrend as per Dow theory says that okay, just this is just a reverse. That okay, downtrend means if if the current low is the previous, so low means if the current high means while stock price is coming down, so it is making a low and then maybe the some high and low and some high. Okay, so if the current high is the lower than the previous high, and again the next high is the lower than the previous high, and so on so forth, that is the condition one. And the condition two is the low current low is lower than the previous low, and again the next low is lower than the previous low, and so on and so forth. If do these two conditions satisfies, this will be treated as a downtrend. And again, to repeat, time frame doesn't matter. It the same concept will be applicable in any time frame depending on your trading style or the investing style. And the third one is the sideways. So where it is the mix of that. So there is no clear cut the higher high or the lower low, or even if it's a mix of highs are maybe one high will be the higher than the previous high and the other high will be lower than the previous high, and similarly for the lows also. So the low is the lower than the previous high and the low is the higher than the previous high. So the mixed trend. And when we observe such trend, it will be called as a sideways. And again, I mean, just a quick one. No no trend remains the same. So in any condition, the trend is going to change. I mean, no trend is going to be remain for forever. And so that is where sometime we may need to wait if we we don't find the trend in our favor. So this is about the Dow theory. Yeah. So underperformer, outperformer that we have already seen. Some chartistic, candlestick examples. So each candle will have the four values that will be the whenever we see the body of the candle. Okay, so body of the candle means the red or green formation. So that is called the body of the candle. And if the one just line upside or downside, that is known as a wick. Okay, so any candle has the four parameters, you can say, or the four values. So whatever the highest point of the candle in a, for example, in a red candle, we will call it a open, and the lowest point of the body. Body means the red or green. Okay, so open, close, and considering the wick, so high and the low. Okay, the same four value will be applicable for a green one also. And the middle of the candle line, but whatever line, if you cut the candle in a horizontal, maybe half in between, in the middle, that will be known as a medium. Okay. Yeah, just a few example. Time frame, we have already discussed monthly, weekly, daily, hourly, or minute. Like minute will be also 30 minutes, 15 minutes, 5 minutes. And there are a few more time frame. Okay, the 4 hour, 2 hours, 45 minutes also. Okay. And if you need maybe more information about this chart and hourly, maybe you can watch my video on how to use investing.com, which I have already shared. Yeah. Next concept that we have learned is trend lines, and there are two type of trend lines: support and resistance. So in general, support line will be considered as any line on which, so support is a simple term. Support is something you know uh, bottom. Okay, so when we provide some support means that is from the bottom or from the down, and it could be a slanting support line or the horizontal support line. And this is the kind of a pseudo line which we can draw on a chart by connecting all the lows. Okay, so all the lows could be horizontal or in a slanting line. If you connect all the lows, and whatever the line that it makes, it will be termed as a support line. So in this example, this red line is the support line. Okay, a few more examples, support lines. And whenever the support line breaks, okay, so that known as a trend line breakdown. Okay, so breaking, it is a support line is breaking in a downward direction, and that is why it is known as a trend line breakdown. Yes, a few more example of support. And another um, trend line is called resistance. So resistance is always on the upper side when the price is moving, trying to move up. And if there is any price point or any pseudo line which is resisting the price to go up, okay. So either it could be horizontal or the slanting. And if we connect all the highest point, and that line will be known as a resistance line. So in this example, the red line is the sub resistance line. And drawing, see, whenever we start any chart analysis, the first thing we do, or we should be doing, to drawing a trend line, that means a support or resistance line. And this is the one of the very basic concept which will be with us till no matter whatever we are doing, right? So even till fourth level. Okay, so this trend line analysis, trend line, drawing a trend line is very, very important, right? Based on this trend line, we are going to get, many things. I can say the targets, sometimes stop losses. Um, okay, so this is a very, very basic and one of the most important concept in the stock market. Trend line, that is support line, and resistance line. And whenever a resistance line breaks, is called as a trend line breakout because it's a resistance. So that means it's stopping price to go up. When it breaks, it will be the breaking out. Means breaking and going above the resistance line. Right. A few more example. Okay, the trend line. And whenever the another concept is called whenever any resistance line breaks. So if it is a resistance, if it breaks out is happening, after that the same line will work as a support, and the vice versa. If there is any a support line, which if it is breaks down, and after that same will work as a resistance. So in this example, there is a resistance line, and at this price point there is a breakout is happening, and later on the same trend line is working as a support. Right. So any questions so far?
No, that's okay.
Great. So few next concept was the candlestick pattern. So we have learned three kind of candlestick pattern. That means the bullish, bearish, and neutral. And bullish, okay, we'll have five types: bullish candle, hammer, bullish piercing, bullish engulf, morning star. Bullish candle is like any green candle. No, any individual green candle will be known as a bullish candle. Okay. um, and the additional one like the hammer. So hammer will have a kind of a, first if you just put the hammer where the iron part will be the upside and the handle the lower side. If that kind of formation, and the candle color of the candle doesn't matter. And typically this hammer uh, should be, I mean, the body of the hammer, or the body of the candle should be lower, and the wick should be 2 to 3 times bigger than the body. Okay, if such formation is happening, that will be known as a hammer. And the important point to remember that they are considered as a potential bullish reversal sign when found at the bottom of the downtrends. Okay, so any stock is falling, falling, falling at any point of time. Once we observe this kind of formation, okay, it will be red or green, doesn't matter. That will be treated as a one of the possible reversal. Maybe from there, maybe we can think that okay, the price is not going to fall further, and from there it is going to reverse. Okay, and there are a few examples. Okay, I'm not going to there. Um, Second one example was the bullish piercing, where it is a combination of two candles, where the first candle is red, that is the bearish candle, and the second candle will be green. It may Second green candle may start from the maybe at a gap down. The gap down means lower than the previous candle or at the same level. The both possibilities are there. The most important thing is the green candle should close above the median. Median means if you cut the candle halfway through, above the median of the first bearish candle. Right. So if such formations are there, it will be it will known as bullish piercing, and it is a sign of a bullish candle. Okay, so whenever such formation is happening in any time frame, we may forecast or for that the overall trend of the stock, maybe it is going to reverse or going to be bullish afterwards.
So basically, if it crosses the median up and goes upward, then it's bullish, right?
Right. So even by looking at these two, I mean, after that, I mean, it may, so no need to wait for the confirmation. I mean, saying that this is the one, it is one of the conviction that, okay, we can, we can, we will be kind of no, start thinking that, okay, it is going to go up. And when we learn about the implementation, then along with the candlestick pattern, we are going to apply few more concepts together. But in this one, if we find such formation, and typically, when it happen when the price is falling down and down, and after that it may show such kind of two candlestick pattern, and from there we can think of that, okay, yes, now from now and onwards it is going to be a bullish market, and we may consider entering if we are maybe if we are in a we can consider for a long getting long or maybe buying the stock basically. And few more concepts that we will be applying on top of that. Okay. Yeah, so examples will be like this. So after that, this is LNT. So from this is the kind of a downtrending market in a daily time frame, and when this made this kind of two uh, candlestick formation, that is a bullish piercing, and from there it got reversal price when it started going up. The next example of bullish candlestick pattern is the bullish engulf, where again it is a two candle um, I mean, true candlestick formation. Okay, where the first one is the will be a bearish candle, that is a red candle, and the second candle will be the green candle. And there may be a three possibility. Either it may, you know, green candle will start at the same level, maybe a close also at the same level. Second one example is maybe they start as a uh, little gap up, or maybe also the same level but closed above the previous candle. And the third example could be it may start at a gap up. So gap up means the next candle is not starting from the same level from where it fell. Basically, it is taking a little gap and then starting from there and closing above the previous candle. So whatever will be the situation, all are the example of bullish engulf. And you don't need to remember basically just by looking at the chart. Okay, by looking at the candle, we can see that okay, the first one, the second candle is completely neutralizing the effect of the first red candle. So that means the red candle in market uh, uh, fell from this level to that level. Okay, and the next candle is completely kind of eating out the effect and taking the price up at the same level or maybe above than the previous level. That is what it says. Okay, so again it depends on you how you will remember, but by looking at just a chart only you should able to know that okay, yes, it is completely neutralizing the effect of the first bearish candle. Okay, and the next one is the morning star, and again it is a three combination of three candles. And technically, if you look at it, is the uh, kind of a bullish piercing itself. Okay, so bullish piercing what? Sorry, bullish. Yeah, bullish piercing on basically. So rather than having the two candle, it is having a three candles. So where the middle candle, the color of the middle candle doesn't matter. And again, if you look at it is if you combine these last two candles, it is basically showing the you know the bullish piercing example only, where it is the second candle is again starting at the same level or maybe a little bit lower, but closing at the mid above the median. So I'm just giving the combining the last two candles, or in simple term, just ignore the middle candle, whatever the color of the candle is. Basically, it should be a smaller or neutral candle. Okay, and the most important thing is how is the formation of the third candle. So either it is start at the same level or at the little bit gap up. But most important thing is should be closing above the median. And same example is also here. Okay, rather than the green candle, it has a red candle, but the third candle is again closing at the above the median of the first candle. So if such formation is happening, that will be treated as a morning star.
So it's basically a bullish
Yes,
candle with a gap in between.
correct, correct. So
Why it is called morning star? Just out of curiosity.
no, this some fellow has just named it. So there is no, I have not heard any story, but how to remember? Morning star means the just my morning you can consider the bullish, something is going up, so sun is going up. That means the bullish. That is how we can remember morning star means the bullish, and similarly the equivalent of that is evening star. That means the overall market is going down. Okay. Um, so yeah, so that's all. Formation of the candle, I think we have already explained how it is happening. The red candle and the green candle. Um, bearish candle still pattern. So there are again the five candles. That is a bearish candle, inverted hammer, bearish piercing, bearish engulf, and evening star. Any bearish candle is any healthy red candle. That is a bearish candle, and rest four are inverted hammer. So inverted hammer means this is just a reverse or the opposite of the hammer, where the main body of the candle is the lower side, and the color of the candle doesn't matter. And the same thing like a wick, the height of the wick should be 2 to 3 times larger, or 2 to 3 times longer than the body of the candle. And the most important thing, how to use. So basically, it if it is found at the top of the uptrend, and in that condition, if we found such candle, it will be maybe there will be a sign of potential reversal. Reversal means, that means if the uptrending market, it is going to fall after making such candlestick pattern. And again, time frame doesn't matter. So yeah, this is just example of Adani, where it's made a the hammer, and after that the stock price started falling down. Yeah, similar to the bullish piercing, there is a bearish piercing, where it is again a two candlestick pattern. First candle will be the green, second candle will be the red, and I mean, the second candle it may start at the same level of the first one, or the little bit gap up of the first candle. But the most important thing is it should close below the median of the first candle. So if such candle formation is happening, it will be known as a bearish piercing. Okay. So yes, this is the example of bearish piercing. Okay, so so first one is the green, next one is the red, and after that, overall there is a fall happening in this nifty, and this example is in a daily time. Next one is the bearish engulf, where again it is a two candlestick pattern, where the first candle is the bullish candle, second one is the bearish candle, and there are three possibilities. Okay, either it will start at the same level, close at the same level, maybe start at little gap up, and close maybe a little closer to the first red green candle. And the third example is it may start at with a little bit gap down, and also close a little below or the first candle. So no matter whatever is the combination of these three, these all are the example of bearish engulf. And just to in a simple way to remember how white is bearish candle, because the first candle, the bulls are tried taking the price high and high, but the second candle is completely eating out the effect of the first green candle. So it is engulfing the complete, the bears are engulfing the complete bull effect, and that is how it is the bearish candlestick pattern. Right. Any question? Please stop any point of time if you have any question. Um, this
No,
example.
this is okay. I mean, I
Yeah,
think this, yeah.
great. Similarly, the equivalent to the morning star, we have a evening star. Again, this is a three candlestick pattern, where the first, we need to put attention on only the first and second. First candle is the green candle. The third candle will be the red. In between candle, the color of it could be a red or green, doesn't matter. It's a small or neutral candle, we can say. And the most important thing is the third red candle should close below the median of the first green candle. If such a candlestick formation we can see, that will be known as evening star, and that is a sign of potential a reversal or the fall of the that particular stock. Okay. A few candlestick pattern called as are neutral. Okay, and those are the doji, spinning top, and the harami. Yes, spinning top is again there's a small candle, I can say. Body of the candle, the color of the candle doesn't matter, so it will be comparatively smaller candle with the wicks both uh, top and bottom. Okay, so that's candlestick formation is called a spinning top. um, Doji is again a very thin body. That means the wherever the market is opening, it is making some high and some low, but the end of the day or end of the time frame, it is closing almost at the same level. Okay, so in the example, if you see the very thin candle, green, it could be green or red, doesn't matter. Even this example here is also example of doji. Okay, so and these are the neutral candlestick pattern. That means they are neither saying bullish or bearish. And the third example is the um, um, bullish harami or bearish harami. This is both the same. So in the bullish means the first candle will be the red one, and in the middle of the first candle there is a smaller green candle is making. And again, just to remember, I mean, just for the analogy or to remember, it may look like a pregnant lady, and that is how the candlestick pattern formation happening. It will be known as a harami. So if the first is red, second one is a green, it will be a bullish harami. And the first one is green, second one is red, it will be bearish harami. But in the both the condition, these are the neutral neutral candlestick pattern. That means it is not suggesting anything, either bullish or bearish. That means we can simply wait in this situation for the trading. When the next clear candle formation will happen, based on that, we can decide for the trading or investing. Okay. Yeah, the next concept that we have learned is the volume. So volume is again the displayed at the bottom of the chart, and the gray line, it says the average of the volumes, and the red and green are nothing but again this depicts the volume, and the color of this red, the volume will be simply depend on the color of the candle. So what volume represents at any point of time. That means in any time frame, the number of stocks being traded, it represents the value. And if the volume is higher than the average, and which that means which is supporting the move. So if there is a uptrending market and volume is also healthy, then we can also say that okay, yes, it is a real reflection of if the true price hike is happening. If volume is not supporting to the price hike, or volume is not supporting to the price fall, that means whatever is shown, it may be a pseudo effect, or it be a kind of a just to confuse. It may not be a real uh, up or real high. Okay. Yeah, this is just example. Like here, the trend line breakdown is happening. At the same time, if you see the volume is also very high. So if the volume is also very high and breakdown or breakout, if anything is happening, that means we can be again the one more level up, maybe from the conviction purpose. I mean, we will be convinced little bit stronger than whatever the trend it is showing. It will be mostly correct only. So that was the concept session 1. These are the things that we have learned. Okay, let us quickly go to the concept session 2. What are the topic that we have covered? I think the concept session 1 was the one little bit longer than the other one. So concept session 2, they are just only two things: moving average and Fibonacci retracement. Okay, and the moving average has again the two part. There is the SMA, the simple moving average, and the exponentially moving average. Right. So SMA, that we know there's a in trend indicator toolbar. This is here, kind of a graph with a multiple bars. We can go there and add the how the MA, and typically we are looking for the MAs in the 3 time frame, 5, 13, and 26. Okay, and moving average has a two component, that is the um, positive crossover and the negative crossover. So positive crossover means when uh, the moving average line of the lower time frame is crossing the moving average of the higher time frame. Crossing over means the crossing the positive direction in upward direction. So that will be considered the positive crossover, and it is giving the under conviction for the buy signal. That means going long or purchasing the stock. Okay. So this in this example, the pink one is the 5, blue one is the 13, and red one is 26. So if you look at wherever I have highlighted, so it at all the places, 5 is crossing over 13, 13 is crossing over 26, and I can say 5 is crossing over both of them, and 13 is crossing over just 26 in all the places. So that means wherever that has been circled, these are the potential entry points. That means potential, I mean, purchasing the stock. And this is example of Infosys after the COVID. So after the COVID lockdown, there are the multiple options of buying the stock. So for example, the 2020, somewhere in 2020, the price fall even below 500, somewhere 460 or something. And the last year, sometime the price went up to 2000, nearly 2000. So for example, somebody could have invested maybe just for example 10 lakhs. Okay, so in 2 years the 10 lakh would have become 40 lakhs, you can say 4 times appreciation. Sorry, 400 times. Yeah, 4 times, in 4 times or 400 time appreciation. So such examples are possible only in the stock market, provided we are doing it with the right analysis and the right technical analysis, basically right learnings. Okay. Yeah, another example of moving average is the negative crossover. So it's the same thing. That's a reverse concept. So we are again adding the 5, 13, 26. In the negative crossover means the lower time frame moving average, if they are crossing the moving average of the higher time frame. Okay, that will be known as a negative crossover. That means the 5 moving average is crossing downside to the 13 and 26, and 13 is also crossing down to the 26. So this is the place where 5 is crossing both and the 13 is crossing 26. And once that phenomena happens, it will be known as a negative crossover, and it will be a possible short sell time of the short selling. Or if we are already purchased the stock, it is the time to get exits, right? And again, this is a very, very recent example where the Adani stock started falling from the 30, more than I think around 400, sorry, 4,000, and it went up to again 1,000. So it is again the 400 times, not four, okay, so 40 to no, sorry, 300 times basically the reversal happens. So either somebody were already long, somebody have purchased, they could have sold their stock here, exited the position, or maybe if you are somebody likes to do the short selling, they could have shorts. They could have done the short selling here and again purchase it here. So it is a very, very quick. I think it is just a matter of a couple of weeks. Okay, where they might have become, or the like got the return of 300 times of their investment, depending on the simple moving average negative crossover example or the concept basically. Okay. Similarly, there is a example. There is a exponential moving average. So rather than a MA or SMA, we are adding EMA, and uh, I mean typically the lower time frame it is observed, but again whenever we do the such analysis, we need to apply these things into a into the chart, look at how they are behaving. But typically, if whatever I have seen in some of the stocks like TCS or even Infosys or the big company, big blue chip company. When I say blue chip company, I will tell you when what I mean by blue chip companies. Okay, so in an maybe during the implementation session. Okay, so those blue chip companies, if such, if you apply in a longer time frame, it will be maybe 50 or 100, and based on this concept of also like a positive crossover, these are also maybe based on this simple concept, you can do the long term investment basically. Okay, so if a time frame, like if the EMA of the lower time frame is crossing over, that is crossing upside the upward direction, it is called as a positive crossover. And if they are crossing, the lower time frame is crossing the higher time frame in a negative, in the downward direction, this will be known as a negative crossover, and which is a potential sell signal. Okay, so here I just for the example here I have added my 5, 13, 26, even a 50 also. Okay, so these are the this is this recent example. I mean, last couple of months, the Wipro stock, or I can say most of the IT stocks are falling. So whenever we could have seen such a negative crossover happening, we could have planned for either a short selling, or suppose if we are already in a long position, we could have so exited our positions and maybe you know started doing the short selling, if based on our the trading style. Because most of the time what I have seen that people feel more comfortable in buying first and then selling later. Okay, so short selling, I think it once you do a little bit practice, and again once we learn the future level, that is the futures and option, there maybe we'll learn more about the short selling, uh, how to do the short selling by using the futures and all. But as of now, just learn this concept, and maybe we can use for this crossover, this type of negative crossover for exiting the R positions. And again, this concept is again going to help as a foundation for the learning of next levels concepts. Okay. So again, that's example of the EMA based entry or exit. So if you see here the positive crossover, the potential entry point, and once the targets are achieved and it had taking giving the or having the negative crossover, that is will be treated as a ideal exit position. Okay, based on the simple EMA. And on top of that, we are definitely going to apply few more concepts like support, resistance, etc., etc. But again, EMA and SMAs are one of the possible, I mean, a strong concept for long-term entry and exits. The next concept are the Fibonacci retracement, and it is very simple concept that okay, whenever there is any stock price is going up, okay, it will not go straight. Okay, they may take rest, but how much rest will be treated as healthy, that we are going to learn about this Fibonacci retracement. Okay, so it has the various level. I mean, this is how this example looks like. Okay, this is the ICICI Bank. It is start from some low level. It is start going up and up, but at a certain price point, it kind of a reverse, and maybe the price went down. Okay, so how much uh, coming down will be treated as a healthy retracement level? That is the Fibonacci retracement is going to tell. Okay, uh, maybe how to put that particular the tool. If we need still, maybe we can have a quick look. Otherwise, the very simple tool, and from the toolbar we can select it, and the first point would be the where from where the price is started making high, and the second point could be at the top. Okay, retracement level is calculated. It will be automatically show these levels like 23%, 38%, 50%, and so on and so forth. And in general, what is considered as healthy retracement, that is the 50%. So if the uptrending market stock price came down up to 50% level, that will be treated as a healthy retracement. That means up to 50%, it is normally that, while going up, it will take some rest and come down. But any point of time it is going beyond 50%, that means it is not a healthy retracement, and we need to be very, very watchful. It is going beyond 50 or maximum 60. Okay, what I can say that, okay, if it is going beyond 50, simply just exit your position. No need to wait. Okay. So and above that is 23%, 38%. So these are the additional, these are the also points we can consider for deciding a target or the stop losses. Well, how to do that, that we'll learn further in the implementation sessions. But as of now, just focus on what is mean by Fibonacci retracement. It helps in identify the support, resistance, targets, and stop loss. Okay, Fibonacci retracement, the downtrend markets. That means we need to see from where the stock started falling down, and once it is reached at the bottom, it may bounce back at a certain level, and that certain level is called a retracement level. And again, it will continue to the same main trend. Say this example, it started from here, went down up to, it maybe how much? It is a NTPC. So NTPC maybe somewhere around 150 rupees. It fell down till how much? Maybe 110. Again, it bounced back, and again it started falling back. So how much is the healthy? That we'll see from the Fibonacci retracement. So in the downtrending market, when we choose the Fibonacci retracement tool, the first one, the first click we should be doing at the top from where the stock started falling. And the second click should be at the bottom where till till the price point it fell down. Okay, so in this example, if we say that there is a retracement happening, but the maximum retracement is happening maybe somewhere around 42% or so, because it's above 38% and below 50%. So I'm just assuming it will be something around a 45 or so, and which is again that it is a healthy retracement. So maximum we could wait till 50%. It is going above 50%. That means simply exit your position. No need to wait further. So till 50%, you can be a little confident that, okay, because it is a healthy level, so you can safely wait, and then mostly it will come down again. But it is again, if going above the 50%, as I said, we need to quickly exit our position and wait for the right opportunity to take an entry again. And these are things are again happening the daily time frame. So maybe initially, uh, if somebody is not comfortable with intraday or long term, depending on your style, you can choose the time frame and you know put this tool and take your decision accordingly, along with some other decision also, which again I'm saying we will learn in the implementation session. Okay, so these are the. Is there any question on so far what that we have discussed?
No, that's okay.
Okay, fair enough. Next part was level 3. Let us see what are the concepts that we have learned in this one. So PPT was having some issues, so I'm taking the help of PDF file. Yeah. So it is basically some chart pattern. So just by looking at the chart at the high, not by looking at the individual candle, but looking at the chart as a whole, maybe a little higher time frame, like maybe daily or weekly, and looking at some charts, how can we identify the market? Okay. So there are three chart patterns: bearish, bullish, and the confirmation pattern. So in a bearish chart, sorry, yes, bearish chart pattern, we have learned about three. One is the head and shoulder, where in the head and shoulder, it will be in the chart, it will be like any human being, where in the middle we can find the head, and the left side, the left shoulder, some kind of this formation, and right side, right shoulder, something kind of this kind of formation. And once we connect the lower of the left shoulder and the right shoulder, that will be named as a neckline. Okay. And because we may not able to identify the head and shoulder by till the time it comes here, and that is the reason we need to wait. Okay. There are some advanced concepts where you don't need to wait till this price point to take an entry. We can we should be able to know the potential reversal or the fall at the top of the trend. That is called as a, you know, um, selling at the top, right? So that we are learning in the advanced concept in the level 4 finally. But as of now, as part of level 1, this is the best entry point is here when the neckline is broken. It will be the ideal sell signal. Okay. And how the target will be identified from the top of the head and the neckline, that will be considered the D. And once the, stock breaks that neckline, that will be a sell signal, and that first target will be equivalent to D. That is the head of the, sorry, top of the price till the neckline. If you have a horizontal line for that, and that line will be a target. I mean, same same price point, or the same, the price difference will be the target once the neckline is broken. Okay, in a head and shoulder pattern. The second one was the double top. Okay, so double top is, it means there are a price point where it is coming again. So, first time it is making all time high, and the second time its price point is coming again closer to that one, or rather touching the same level, and again going down. So double top means it should be, there should be a two topmost position, and if the first, after making a first topmost position, if the price point is going again touching the second price point position, that means that is considered the double top, and it will be again the potential selling time, or the potential time for short selling. Or second one is, if somebody maybe took an entry at this price point, they may plan to exit at this price point. And this is again example of Wipro Limited, where the same price point was touched, and after that market starting falling and falling, and it is still kind of in a falling and recovery mode. Double top. Okay. There are, so there are few bullish reversal chart patterns. Okay, that means what are they? That is inverted head and shoulder. So inverted head and shoulder is a reverse of the normal head and shoulder, or the, okay. So where it is like somebody is doing the Sirsasana, that is a head down and the legs are up. So basically no need to find out the leg here. We just need to identify the head, left shoulder and right shoulder. And similarly the bottom, here the bottom means here should be a upper portion of the left shoulder and right shoulder. If you combine, that will get a give you a neckline. Okay, and if we draw a line from the head to the neckline, whatever distance is coming, similar distance will be used for the target. And once the neckline is broken up, the neckline breakout is happening, that will be an ideal entry point as a bulls. That means we are buying the stock, and once it is giving the target of equivalent to D, we should be exiting our position. Or maybe if we are having a maybe 2 stock or 20 stock or 200 stock, 50%, with the 50% of them we can decide to book a profit, and we can continue with 50% of the stock further. Yeah. Second one was Fibonacci retracement in a downtrend. No, sorry. This is the typo error. Leave, sorry. Just ignore this one. So this is basically again the example of inverted head and shoulder, how it looks like. We can leave it. The second bullish reversal or chart candlestick chart pattern is why I'm saying bullish reversal. That means after this chart, when we observe such kind of chart pattern, it is going to reverse up direction, reverse into upward direction. That means the stock price is going to go higher side. And what is happening here is that it is the all-time low, and when the price point is coming at the similar level, it will work as a resistance, and we have a two bottom. Okay, when such things are things such a chart formation is happening, that will be known as a double bottom. And one most important, remember that, okay, the double tops will be at the topmost position and the double bottom should be at the bottommost position. In such case, such situation only it will be the most effective one. 80 to 90% will be effective. Okay. So again, how to identify D? If we draw a support line come by touching the two lowest point, and uh, maybe a next next resistance line, whatever the resistance line we could see as per the chart. If you draw the resistance line, so between the gap between the the um, these two bottom line, or the support line, I can say support line, and the recent resistance line, that will be equivalent to D, and the similar D will be a target point, provided we are taking an entry at this breakout junction. That means this is resistance, and when that resistance is breaking out, that means it will be a potential buy signal. Okay, and so once we are buying it here, whatever is the distance, that D that we have identified, same D we can apply. And once it is at touch this particular target, this resistance line, you can safely decide to remember. If we have the further maybe some conviction that, okay, it may go further up, at least you can exit your 50% of stocks, book a 50% profit, and for remaining 50% you can have one more one more level of target. Okay. And the last one was the cup and handle, where is the very long term chart chart formation is happening, where is the this is the D, that is the cup, and the other one with a smaller time frame, that is the handle. And the depth of the cup will be a target. And when such formation are happening, there will be a multiple target of the equivalent to D. So at least four or five. So you can safely trade till 4 or 5. After that, you can, depending on the price movement and other factor like RSI stochastic, that we have already learned. Based on that, you can plan to exit. But this one to happen, it will take a long time. So it's about 10:30. I believe if you have any